If we were to again drill down a bit deeper into what market conditions are more conducive for a fund such as yours to perform, is it a trending market like an uptrend or a downtrend market? Is it very high amount of volatility, or are stable markets more conducive? Are these the right drivers of your performance?
So what I'll say that, see, if I'm a true alternative fund, if I'm a true quant fund, right? See, so what typically a good quant firm take pride in itself, right? Good quant firm like us who try to aspire to be one of the best in this industry, what we aspire for is there should not be any one factor. There should not be any one factor which determine my returns. So let's say 2 years back, my India book was doing well when there was higher volatility and was doing bad when there's lower volatility. So what we do behind the scene. So in our research meetings, what we discuss, like, okay, guys, this is not acceptable. The market can stay lower for years and years, right? We can't do that. We cannot just go out and tell our clients that we lost money because market was lower. This is not how it will work. We are an absolute return fund. So whenever we see that there's any factor, so the way we work is if we find any factor on which our returns are dependent on, we through our research try to address that. So it's not like we are very comfortable and very proud and say, oh, we'll make money in volatile market and lose money lower. We don't feel pride in that. We don't want to be that kind of firm. For us, we should be agnostic of, when I say I'm agnostic about market going up and market going down, I should be agnostic about volatility. I should be agnostic. So there's one factor which is a little bit important is liquidity. And even in that, we are trying to address it by making sure that we trade all liquid markets across the world. So we keep adding our universe. So the idea for us is to trade every liquid market available in the world. So we focus on liquid markets only. And let's say theoretically all liquid markets in the world tomorrow become illiquid, right? Then a model like us who trades in and out actively, that's where the struggle might come, if you ask me. But that is part of the business. That's the businesses that we take. But we do believe that there are a lot of pockets which still not touched, because there's a lot of liquidity exists. So for us, it's very simple. As long as there's a liquidity in the market to enter and exit that trade, there's no other factor on which our return should depend on. So from a research perspective, we focus on that. Bring consistency.
And would it be fair to say that a combination of these two things, higher winning trades, better risk reward ratio, ability to trade any and every market, whether trending or volatile, a combination of these two gives you or your fund higher Sortino ratios, higher Sharpe ratios, and for our clients / investors, it's important to know that a global quant trading firm such as 26 Miles Capital delivers a much higher Sharpe ratio or Sortino ratio, which is essentially the reward that you take on every rupee of risk. So, sir, does this convert into higher Sortino and Sharpe ratios?
Yes, you had them rightly pointed that. See, typically alternates, as I told you, the alternate industry only existed to provide uncorrelated, better risk-adjusted returns. So its focus was to provide high Sharpe ratio products where you provide superior risk-adjusted returns, uncorrelated to what is already available in the market, which was traditional long only. You do through ETF, you do mutual fund, you do PMS, you buy on your own, right? The traditional investment class. So the alternate industry, whether what we do or any other guy out there is doing, is to provide something uncorrelated and much better Sharpe ratio. See, though there's a serious amount of wealth creation happens when you buy good stock at good price, but even in that, even if you pick the bad stock and put it at the right price only, even in those scenarios, the best performing fund managers, let's say we today see who was the best guy in last 10 years, and we assume we invested in that guy only. Even in after like hindsight wisdom, the Sharpe ratio you will get will be less than 0.5. So that industry exists for a different purpose. It doesn't exist to provide high Sharpe ratio returns. It exists to provide long-term wealth creation by buying good stocks, but at a much higher risk at decent return, but much inferior risk adjusted returns, right? So, and obviously, when you are putting significant amount of money at risk on one particular investment or one particular style of investment, your risk reward ratios are supposed to be inferior only to something which is alternate to that, which is doing a much active alpha picking, uh, a lot more wider universe coverage, and trying to play up cycle, down cycle, high vol cycle, low vol cycle. So obviously, since we are combining all these things, it leads to a much improved Sharpe ratios. And as I told you right at the beginning of we spent a lot in our technology. We spent crazy on our talent so that they build this machine. They figure out these alphas which are available in the market, which are uncorrelated, provide superior risk-adjusted returns. So constant focus is to find that talent and keep building on technology.
Right. So ultimately,
lot of investment goes in that.
Right. So ultimately, this superior risk reward is a function of talented humans at work.